Well, if you've been lucky in traveling abroad this summer, you would have found your money going further for you, as the loonie has been on a tear lately. But will the Canadian dollar continue to rise? And if we are to see another rate hike or two from the Bank of Canada, could that slow down the economy? Michael Craig is Senior Portfolio Manager at TD Asset Management. Joins me here. Nice to see you.
See you.
It has been on a tear, up what, about 10% over the summer?
Yeah, it peaked, the lows were around early May, and then since then it's been almost a one-way train. There's been a real reversal in the market. First, you had a pretty massive positioning against the Canadian dollar globally, so everyone was trying to play a housing meltdown, what have you.
Didn't materialize.
And then the Bank of Canada basically did a U-turn alongside some other central banks and went from a very kind of slightly dovish to neutral tilt to hawkish, and then we saw the rate hike in July. So it's been a, for someone who is short the loonie, kind of a worst case scenario, that the impossible happened, and here we are back at around 80 cents against the greenback.
I mean, the one thing that's interesting, is we're kind of waiting to hear what's going to happen with the Bank of Canada next, and it seems to be a little more tricky, I'd say, reading the tea leaves than it was a couple of years ago, I'll say, with the Bank of Canada. But you've brought in a chart, a couple charts actually, showing the Bank of Canada's forecast for inflation. So tell me what we're seeing here, because I seem to think we haven't been seeing a whole lot of inflation.
Right. So part of the bank's commentary was that they thought that the economy would get back to full capacity next year and that we'd be at 2% inflation. And what we're just trying to show, and we're not trying to pick on the Bank of Canada, it's been the case in many banks, is that that solid yellow line has been their forecast for the last,
which is 2%.
They're 2%, yeah. For the last 5 years, they've been forecasting that we would eventually hit 2%. In reality, is that we've been about on average about 60 basis points light of that ever since. And so we think that the way that banks think about inflation is going on kind of previous models that aren't necessarily as applicable today. The impacts of technology and globalization have totally changed the inflation component of goods and services. And so there's a lot of debate about this, but for me, it'll be very hard pressed to see, particularly with the move in the currency, to see inflation back to 2% by next year.
How do you, and I guess as a central bank, what do you do then? Because isn't your kind of raison d'etre to manage the currency for inflation? So if there is no inflation, then what? Yeah,
so I think historians look back at this point in time and probably point to when central banks started looking at perhaps things other than inflation, and we would argue that's going to be credit. And what's in place goods inflation has been asset inflation, whether it's stocks, bonds, real estate, art. All these things have gone up tremendously over the last few years. And this is really a reflection of credit. Credit growth has also been tremendously easier. There's been work that the BIS has done, and they've been arguing that banks use this idea of output gaps, where they look for that kind of equilibrium rate where inflation isn't running faster than the economy. The economy can sustain this type of natural rate of growth. BIS has argued, actually, you need to really look at credit growth. And if you actually looked at the financial crisis and looked at the credit growth in the U.S., you'd see that it was well above kind of sustainable levels. And you think about it, as credit becomes easier and easier, we do silly things with it. We start to misallocate it, consumers buy too much, and we get extended, and as soon as that tightens up, you have this kind of catalytic reaction.
We've got a second chart you brought here, and let's bring this one up and tell me what we're looking at here and why you think this one's an important one.
So one of the enjoyable things about my job is that we really never solve anything to the perfection. There's always ways to kind of do things better.
That's enjoyable? It's frustrating?
It's kind of like you're constantly kind of innovating, I would say. We've taken work from the BIS, and what they've said, that solid blue line is what we call a financial neutral cycle. So what we're really looking at is growth, and then looking at growth with regards to credit growth and asset price growth.
Okay.
And what you see, and what this chart shows, is the difference between the U.S. and Canada. So those shaded areas are where it was tighter in Canada, and the non-shaded areas was where it was tighter in the U.S. And what you find with this is when you look at the currency, the average currency movement over time, is that when credit conditions are hot here, the loonie tends to do very well on a structural basis, or and the reverse is true. When credit is tighter in the U.S., you seem to see the loonie weaken. Since 2011, U.S. has been closing this gap, so it's been quite beneficial to hold U.S. dollars. But now we're getting back to a neutral setting where the Canadian economy probably is at full capacity, but not so much with inflation, but with respect to credit, which makes total sense if you think about all this talk about house prices and credit growth and household credit growth and corporate credit growth in Canada. We're at a point where we're kind of tapped, and we need to throttle it back. So using this rationale, it makes total sense to hike. The question is what part of this economy is going to take over from the housing market to drive growth going forward?
And that's a question just not for Canada, for everywhere, I guess, too.
Absolutely.
Yeah. So what does this mean for the Loonie then for 2018? I mean, you said it was supportive in the past little while, but what do you see end of this year and next year?
So our work would indicate that Loonie has now gotten expensive.
Yeah.
We think that that this kind of unwind of this position is now finished. Now people are actually net long. And the speculative markets are net long the Loonie. So if you're going to plan on that European vacation, now is the time to do it.
now.
Do it now, or buy those euros now for that vacation. The bank's going to probably hike again this year, and then we're going to really see. That's kind of where the pedal hits the rubber hits the road, in the sense that those parts of the economy that are really sensitive to interest rates are going to slow. And the question is what's the next driver? Is it commodities, the commodity part of the economy, or is it technology or manufacturing? One of these areas has to step up if we're going to see kind of growth going forward. Otherwise, we're going to come to a real slowdown in the Canadian economy.
I've got about 15 seconds, but if you were a betting man, I was asking Bill the same thing. But if you take a look at those drivers, which one do you think is most likely to step up?
I think it's going to be technology. Quite frankly, I think Montreal, Toronto, Vancouver, now even Calgary, you're seeing real centers of technology hubs. There's like 15,000 technology companies between here and Hamilton and Waterloo, that triangle. That is the area of the economy that's really growing. Is it going to grow enough to kind of lift everything? Tough to say, but I would say that's where I'd lay my bets.
Michael, thanks very much.
Thank you for having me.
Michael Craig, Senior Portfolio Manager with TD Asset Management.